Welcome to today's webinar, which is on intergenerational wealth planning. My name is Tony Byrne, and the company is Wealth and Tax Management. So, what is it, and why is it so important to you? Just a few housekeeping points to kick off with. This webinar is aimed to last for half an hour. There'll be 5 minutes for questions at the end, and by all means do ask questions as we go along by entering them in the box in the bottom right hand corner of your screen. If we don't have time to answer your questions, we will follow up by email and or phone, and copies of the slides will be sent to you after the webinar. Your feedback will be most welcome. So what are the intergenerations? As the name implies, it's these different generations of folks. In this example, we've got grandparents with their children and their grandchildren. In a nutshell, that's what we're talking about today. So, why do you need to plan for this? Well, intergenerational wealth management is really about how families use their collective wealth to support each other during their lifetimes. And it's because there's been increasing life expectancy in recent years, and more generations are living together. And in fact, we're getting generations where there's parents and their children are already retired. We're going through quite a big change at the moment. The so-called baby boomers, those born in the post-war era, are now the wealthiest generation in history. The trouble is, the same people are known as the sandwich generation, in that they are in between elderly parents, maybe facing challenges of care fees, and children struggling to get on the housing ladder. And I'm one of those people myself. So traditionally, wealth is passed from one generation to the next on death. But what's happening now, because people are living so much longer, there's more of a drive towards working together, the different generations, to support each other during their lifetimes, and more gifting is being made while people are alive. And I've certainly done that myself with my children, gifted them money, and I'm not the only one. A number of our clients have done just the same. Because why wait until you die? If you live a long time, you don't want to be gifting money primarily to your children when you die, because by then they may be retired themselves as well. So surely it's best to help them during your lifetime, when they're younger and they really need the money the most. There was a study by St James's Place into intergenerational wealth and retirement planning, and what that's revealed is that the number of families with multiple generations in retirement at the same time will exceed 1 million in the next 20 years. We've got one client ourselves who's 95, and he's got two sons who are both retired themselves. So this is by no means an exception. So forgive the pun for the Who song, talking about my generation. I couldn't resist it. I love this slide. And this is just a slide showing the different types of generations and their various names, which I thought was quite interesting. But the ones we're most familiar with, we're talking about today, are the baby boomers, as you can see on the right-hand side, millennials, which is otherwise known as Generation Y, and of course Generation X, which is the generation after millennials. They're the main ones we'll be talking about today. So baby boomers, as I mentioned earlier, they're the wealthiest generation in history. But things are going to change quite dramatically in the next 26 years, up until 2047, when there will be a massive transfer of wealth of £5.5 trillion in the UK from baby boomers to the younger generation, particularly the millennials. And so millennials, who may currently feel they're hard done by for various reasons, will in fact become the wealthiest generation ever. If only because there are less of them than baby boomers. And there's going to be a lot more increases in life expectancy. So more generations are going to be coexisting. And much more of the population is going to be over 65 in the future. So that's something else to bear in mind. So how do these intergenerational issues affect different groups of people? So as I mentioned before, assisting aging parents can be increasingly a problem for baby boomers. And discussions on the subject of death and who stands to inherit the parental estate, concerns over who looks after parents that lose mental capacity, and so on. So it's really important to have a trusted advisor to help you get through all these challenging issues. And then for children or grandchildren, you've got your own challenges as well of making sure that you're saving enough money and that school and university fee planning is in place for your children or the grandchildren. In this example, you may be wanting to help the younger generations to buy the first property. I've already done that for 2 of my 3 children, my adult children, and the third one hopefully in the next 12 months. So I'm a living example of that. And also try and be a good guide to your children how to use the savings options that are available. And of course, providing financial support for younger children in the event of parental death. Student debt is a massive issue. The more I've investigated it, the more I've realised that it's not like a normal loan at all. And in fact, the repayments are more akin to a taxation on students rather than true loan repayments. And I think it's something that is advisable to pay off as soon as possible. But you've got to watch the traps for the unwary, because if you think you're making a partial repayment of a student loan, you could be in a trap there where you haven't really made the partial repayment you thought you made. Unless you're confident you can pay it off in full, it's probably not a good idea to make partial repayments. You'll still be stuck very heavily on repayments. But as I say, it's not like a typical loan. So, as I mentioned earlier, people are increasingly transferring wealth during their lifetimes. For some of those examples I've already mentioned, like paying off student debt, helping children put money down for deposit on a house, and so on. There's many ways to pass wealth to the next generation, but the key thing is to do it in a very, very tax efficient manner. Unless you really understand it yourself, best to speak to an advisor who's practiced in these things. It can make a huge, huge difference to getting it right, rather than face unnecessary, unexpected tax traps. Interestingly, the amount of money lent by parents to children, if you were to put it into a table based on the top 10 lenders in the UK, the bank of mum and dad would make the top 10 if it were a bank. So that gives you some idea of the huge amount of money gifted or lent by parents to the children these days. So I've got a few ideas here of some tax efficient wealth transfer best practice guidelines, if you like. So I think on this slide I will read out every one because it's so good. There's countless tax efficient strategies for transferring wealth, too numerous to cover in a short webinar like this, but if you follow the general guidance below, you will maximize the likelihood of getting it right. So the first thing is, don't let the tax tail wag the investment dog. In other words, don't invest purely for tax reasons. The underlying investment has to stack up in its own right first. If a tax efficient wrapper can be added to it, such as an ISA or a pension, then so much the better. But make sure it's the right investment first. Ensure you take advice from a tax specialist and or a financial planner who specializes in tax efficient wealth management. Maximize the tax allowances and reliefs that are available. There are literally thousands available from the HMRC website. Hard to believe, but you do a Google search, you'll find it's true. Be clear about your objectives before gifting money or assets away. Don't create an own goal by worsening your own financial situation or the transferee's financial position. I've come across cases where people have been very generous, gifting money away, but they've actually compromised their own financial position and put themselves into great financial difficulty. I know it's great being generous, but think of yourself first. Don't put yourself in a worse position. It's too much of an own goal. And as for the advice from a friend or colleague or relative, like the man in the pub, your mate in the pub, don't bother. These people, they mean well. You trust them because you like them, or they're your friend or a relative, but most of the time they ain't got a clue, and you're just making a punt. Be prepared to pay for high quality advice. You really do get what you pay for. So, some tax efficient wealth transfer strategies. So, we're going to cover the different taxes, and the first one we're going to cover is inheritance tax. Most gifts you make, particularly to descendants or parents or grandparents, they're normally known as what's called potential exempt transfers, or PETs for short. Nothing to do with your dog or cat, of course. The issue here is that the gift is normally free of inheritance tax unless you die within 7 years of the gift, in which case a certain proportion of it will still be liable to inheritance tax. The first 3 years, 100% of it is liable to inheritance tax, and after that, it reduces on a tapering scale. So just be aware of that. There are many little gift exemptions. I won't read them out because you can read them here on the screen. There is something that's not used very often, but most people aren't necessarily aware of this, called the normal expenditure out of income rule. What that means is that as long as your standard of living isn't reduced, you can make regular gifts that don't get caught for inheritance tax. But you do need to do this carefully, and yet again, it's good to use an advisor, especially one who uses lifetime cash flow planning software, because you've got an actual audit trail, a record to prove that regular gifting is not reducing that individual's standard of living, in which case you may be able to make gifts bigger than the ones I've mentioned already here. Gifts into trust are known as chargeable lifetime transfers. In other words, they are subject to inheritance tax, but 50% of this normal rate, which is normally 40%, so 20%. But if the gift to trust is below £325,000, then it's not subject to inheritance tax at that time of making the gift. So yes, do you know the tax implication of gifting? We do get asked this question quite a lot, and it's important to know that there's more than one tax that can be called into account. For example, income tax, capital gains tax, inheritance tax. So there's more to it than meets the eye. So capital gains tax is the next subject. We've just covered inheritance tax. So if you make gifts to, for example, parents or grandparents or descendants, it's still subject to capital gains tax, even though you haven't received any money. You've got to use the value of the asset when it was given as the effective sale price minus the cost. So just be aware of that. There are gifts, small gifts, that have got various exemptions against capital gains tax, and there are rules to cover those. The Chattel's rules, they're called. We haven't got time to go into that today, but just be aware very small gifts of assets are normally not caught by capital gains tax rules. There is an annual £12,300 exemption per person who gifts assets away or cash. If you gift money into certain trusts, discretionary or interest in possession trusts, you can usually do what's called a holdover relief claim, meaning you can defer the capital gains tax on that gift by making that claim. Interestingly, if you gift money to your own children who are minors, they can use their own capital gains tax exemption without any adverse consequences to you, which I think is a remarkable concession, but one that is rarely ever used in my experience. And of course, let's not forget income tax. Now, gifts to individuals not usually subject to income tax, but be aware of this next rule. I mentioned the last slide that gifts from parents to children aren't subject to capital gains tax in the children's hands once they've received the gift, when they've got their own capital gains tax exemption, but this doesn't apply to income tax. So, for example, the same parent who gifted money to children and they realised capital gains could use their own child's capital gains tax exemption, doesn't apply to income tax. If you, for example, gifted money into a bank account and it earned interest of more than £100 a year for your child, then you would be subject to income tax on that interest if it's more than £100 a year. So just be aware of that. Good for capital gains tax, gifts to children, not good for income tax. And then there's a particular type of investment known as an investment bond. If you gift or assign segments, or in other words, fractions of an investment bond to, for example, a child or to other individuals, it doesn't trigger an income tax charge, that assignment, because it's not what's called a chargeable event, not to be confused with chargeable gains or capital gains, which is subject to capital gains tax. Wills, last wills and testament. So just a few tips about wills for you to be aware of. Now, most of you are probably already aware of this, but in case you're not, your will has to be witnessed by two independent people present when you sign it. Otherwise, it will be legally invalid. Probably best to use an unrelated neighbour, typically, is what I would do. But there really must be no connection, certainly in terms of people who are beneficiaries of the will, for example, or the writer of the will, the testator. Another good tip is to store your will with a will writing company for a nominal annual fee, such as the Will Company in Northampton. Not only is your will stored securely, but you're also entitled to up to 3 free will rewrites a year. Now, I know that's over the top, and I don't know anyone who's written a will and rewritten it 3 times in a year. Although I did 1 year have 2 different versions of a will. I did rewrite it once. But the fact that they're free means that you're free to update your will regularly if you wish, and you're just paying the one storage fee, annual fee, which is only, I think, £15, quite cheap really. So you'll get the storage fee back if you just rewrite your will once every few years. You'll more than get your money back. So I think it's a really good service. Not something that a solicitor would normally provide in my experience. And what you can also do is, rather than put a myriad of silly little decisions over minor assets that you own, like, I don't know, some crockery or cutlery or small bits of jewellery, why not just have a letter of wishes to support your will, so you don't have to detail everything, especially if your wishes change every year, and put in the letter of wishes all the small items who you want to go to, rather than having the main body of the will where the main decision should be made. I just think it's good practice. It's not legally enforceable, but it's very persuasive on the executors of your estate to carry out your wishes from the letter of wishes. We also think checklists are very good. We call them death checklists. Well, they're actually politely known as what I own and where it's kept. But the beauty is, with using these checklists of ours, we've got 3 of them, you can detail where everything's kept. For example, your wills, your lasting powers of attorney, your jewellery, or whatever it is. But last but not least, don't forget the importance of your electronic records. People tend to forget this, but should you not leave your login details to your loved ones for your computers, your devices, and also passwords and usernames for websites, for example, or social media. Probably a good idea to leave that for someone to access after you passed away. I think as a general rule, I'd always advise an individual to seek advice before making large gifts. You can make tax efficient gifts to minors, in other words, children under the age of 18. The allowance for junior ISAs for that age group has increased to £9,000 a year. It was £4,368 up until 2019-20. So that's good news because they're free of income tax and capital gains tax. The main benefit, I would say, for minors is the capital gains tax saving, because most of them wouldn't have enough income to be subject to income tax. Yeah, and so these payments can be immediately out of the donor's estate if using an exemption, for example, that I mentioned on the earlier slide. And friends and family can gift money into an existing junior ISA, but only parents and legal guardians can apply for one on behalf of their children. The downside is that once your child gets to 18, they have full access to the account. Most children, I would expect, would be sensible about it, putting the money towards university or getting on the property ladder, for example. But there's no guarantee, of course, so that may be one reason not to do it. You can pay up to £2,880 a year into a pension on behalf of a minor, a child of yours, for example, who's under 18. The government contributes tax relief to that, even if your child's not a taxpayer. So that would add another £720 to it, which is a very nice bonus, which makes it £3,600. You pay £2,880, it becomes £3,600 overnight, which is a boost of 25%. Pretty good going, I would say. So the parent or guardian needs to open the pension, but anyone can contribute to it. And again, the control of the pension passes to the child when they reach 18, but they can't access it until 55, and in practice is going to be 57 by the time they can access the money. There's something else called third-party pension contributions. Again, not everyone's aware of this, but interestingly, anybody can pay into anybody else's pension in the UK, which I find quite interesting. But the pension payment tax relief goes to the recipient of the gift. So, for example, a parent makes a gift into a child's pension, say £800. It grosses up to £1,000. In other words, the tax relief comes back to the recipient, the child, for example, in this case. If the child's a higher rate taxpayer, they get a further 20% off. So you as the donor, if you're the parent, won't get the tax relief, but you can at least put the money into a pension where your adult child or even minor child can get the tax relief. There is something else for the people that are in the income category of about £50,000 to £60,000 roughly. That's where you can start losing child benefit if you've got children. And the benefit of a parental pension contribution into your pension is that it would reduce your tax assessable income potentially below these figures, which would therefore free up the child benefit to still be paid to you. So that's quite a good potential plan, but it won't affect too many people, but there might be the odd one which would consider that. Yeah, so if you're a parent, there might be several reasons you can't pay into a pension yourself. You might have exceeded all your own annual allowances, and so you may decide you just want to gift some money to your child just to reduce your inheritance tax bill, for example. But you've got to be aware that children will have their own limits on how much they can pay in, especially if they're high earners. So you may not be able to pay in as much as you'd like, for example, £40,000, because they might be very high earners themselves, in which case you probably wouldn't even bother, of course. The other thing to be aware of is that gift you've made into a pension for your child, for example, that does constitute a gift for inheritance tax purposes. So it would be what's this so-called PET, potentially exempt transfer. Survive 7 years, free of inheritance tax. So pension gifting on death. Now, what you can do, most people, if they don't get advice, would just their personal pension plan would just simply be paid out as what's called a death benefit, would just go as a payment to the beneficiary or beneficiaries. But a wiser thing to do is to allow your pension to be inherited by your beneficiaries, so it stays in a pension fund. And if the person, the donor, dies before 75, then the entire pension fund is tax-free to the beneficiary forever. So that's pretty good, because personal pensions are free of inheritance tax as well. If it's after 75, then the beneficiary would be subject to income tax only, but it's still pretty good that the pot of money is outside their estate for inheritance tax purposes. So rarely is it beneficial for the money to be paid to the beneficiary as a cash payment. Best if the beneficiary receives the pension in the form of a pension pot, especially if the person who's died, say a parent, for example, or a husband or wife, is under the age of 75. And the other remarkable thing is that the inherited pension to the beneficiary doesn't get added to that person's existing pensions when testing against this lifetime allowance figure of a weird sum of £1,073,100. So the beneficiary may themselves have an existing pension pot of, say, I don't know, 500,000, and you leave them $1 million. Well, normally that would be subject to this higher tax charge, this lifetime allowance tax charge, because it would then exceed 1,073,100, be 1.5 million, and it's pretty high, the taxes, 50%, 55% on lump sums and 25% extra on income. These are the extra taxes you'd pay. So you'd have an example here where you'd be well in excess of the lifetime allowance of 1,073,100, but the £1 million you inherited doesn't count. So it's free of the lifetime allowance tax charge. I think that's pretty neat. And I can't help wondering if the HMRC just didn't even spot that. It just seems to be too generous to be true. So whatever you do, don't forward this webinar recording to anyone in the HMRC you know. So the message is that if you're the beneficiary of money purchase pension, usually better to keep the funds within a pension scheme rather than take the death benefits as a cash lump sum. That's usually the way, but take advice. Sorry, this slide is a little bit blurred, but it's talking about disclosure of family wealth decisions, and it is advisable for parents to discuss their wealth with their children and what they intend to do with it, so there's no surprises or bickering or complaining after death. And this just shows a few subject areas and from a survey of people that have or haven't discussed these issues. And the first one is distribution of assets upon death. Only 36% had discussed it between the family members. Assets already gifted during lifetime. I can't even read it myself here. I think it's 31%. Philanthropic commitments, 27%. Family values and principles, 45% were discussed between family members. So in all cases, well below 50%. I'll just encourage you to discuss it between the family. I think it just prevents ill will and surprises later, and disagreements and fallouts. Best to discuss it in advance as a general rule. So what should you do about it? So do discuss it with your families, I've mentioned. Don't be embarrassed or afraid to do it. And introduce other family members to us to at least get to know us, not necessarily to become clients, but just to build a relationship. We already know a lot of your children because a lot of them are attorneys or executors of your estates. But important to have this discussion with them. And more than happy to invite your family members to our office or via video conference call, or maybe to even accompany you to meetings to our office. What are we doing about it, this intergenerational planning? Well, as we've mentioned that just now, we have already arranged a lot of wills and lasting powers of attorney and trusts to clients and got to know their children because they've been appointed as executors, trustees and attorneys. We do produce a lot of regular educational content for clients, including intergenerational wealth planning. And we also produce a monthly blog aimed at the children and grandchildren of clients, which we're happy to share with beneficiaries, potential beneficiaries rather. We've got an e-guide called 97 Money Gems, and this sister website called Wealth Magic, which is targeted at people who are millennials and younger. Yeah, we do accept family members as clients in their own right, even if they don't meet our minimum investment qualification criteria. We just treat the family member as part of one client offering or one client family group, if you like. So don't be shy of coming to us for advice. So yeah, we'd certainly be welcoming any relatives to come along to meetings to accompany you to get to know them. So what are we doing about it? We're offering a complimentary financial review meeting for up to an hour worth £470 to all family members referred to us. And family members are welcome to visit us with existing clients, get to know us better. If you're a family member, do ask to be put on our mailing list to receive regular educational content on a range of financial planning topics, including intergenerational wealth planning. Ask for a complimentary copy of our 97 Money Gems e-booklet worth £3.97 if you're a family member, as a thank you for attending this webinar. And if you are yourself a millennial or younger, do visit our sister website, Wealth Magic. The URL is there. So if you have any questions, we've got 5 minutes to answer them, or by all means email us after the event, or use the questions section on this GoToWebinar link. Just a few risk warnings at the end. The main one is that, of course, investments can rise or fall. You may not get back the full amount you've invested. Any comments or advice I've given during this presentation is not personalized advice, of course. You should always seek advice from a professional advisor based on your own personal circumstances. So do thank you very much for your time today, and I wish you a good day.